Most people assume financial progress begins with investing. But in practice, the foundation of financial stability begins somewhere else, that is with protection. Before building wealth, every financial system needs a safety layer that protects it from unexpected disruptions. That safety layer is an emergency fund. In my experience studying personal finance behavior in India, many people underestimate this step. Some assume their savings account balance is enough. Others believe their investments will provide protection during emergencies. But when real situations arise like a sudden medical expense, job disruption, or urgent family obligation, those assumptions can quickly fall apart. An emergency fund is not designed to grow wealth. Its purpose is much simpler and more important: immediate financial stability during unexpected events. Think of it as the shock absorber of your financial system. In this video, we'll break down how emergency fund planning in India works, including how much you should aim for, where to keep the money safely, and how to build the fund step by step. An emergency fund is a dedicated pool of money set aside specifically for unexpected and essential expenses. These are situations that are both urgent and unavoidable. Examples include medical emergencies, job loss, major home or vehicle repairs, sudden travel for family reasons, or replacing essential work equipment like a laptop. The defining characteristics of an emergency fund are safety and accessibility. Unlike investments, emergency funds should not be exposed to market risk. And unlike long-term savings goals, the money must remain easily accessible without penalties or delays. It's also important to understand what an emergency fund is not. It is not your regular savings buffer. It is not your credit card limit. And it is not your investment portfolio. A true emergency fund exists for one purpose only: protecting your financial stability during unexpected events. Emergency fund planning is particularly important in India because of several structural realities. Healthcare inflation in India has been rising steadily for many years. Even relatively minor hospitalization can cost tens of thousands of rupees, especially in private healthcare systems. Employment stability has also changed significantly across industries. Layoffs, contract roles, and freelance work are more common than they were a decade ago. At the same time, India has limited social security protections compared to many developed economies. For most households, personal savings remain the primary financial safety net. Many families also carry multi-generational responsibilities, supporting both children and elderly parents. Because of these factors, an emergency fund acts as a crucial financial buffer that allows families to navigate unexpected disruptions without taking on high-interest debt or liquidating long-term investments. A common question people ask is, how large should an emergency fund actually be? A practical guideline used by many financial planners is to base the fund on essential monthly expenses. For salaried individuals with relatively stable income, maintaining 3 months of essential expenses is often considered a reasonable starting point. For self-employed professionals or freelancers, 6 months of expenses is generally safer due to income variability. And for households with higher financial risk, such as a single-income family, individuals with medical concerns, or unstable industries, maintaining 9 to 12 months of expenses can provide stronger protection. The key is focusing only on essential expenses. This typically includes rent or home loan payments, groceries, utilities, insurance premiums, education costs, and transportation. Non-essential spending such as entertainment, luxury purchases, or discretionary subscriptions should not be included in this calculation. Where you store your emergency fund is just as important as how much you save. The goal is not to maximize returns, but to ensure safety and quick access. In practice, emergency funds are usually kept in low-risk and highly liquid financial instruments. Savings accounts provide immediate accessibility, but typically offer lower interest rates. Fixed deposits can provide slightly higher returns while still allowing withdrawal if needed. Some banks also offer sweep-in accounts that combine savings account liquidity with fixed deposit returns. Liquid or ultra-short-term debt funds can also serve as an additional layer for part of the emergency fund, offering modest returns while maintaining relatively quick redemption. Many people prefer using a layered approach, keeping some funds in a savings account for instant access and storing the remaining portion in safe, liquid instruments. Even people who understand the concept of emergency funds sometimes make avoidable mistakes. One common mistake is keeping the entire fund in a daily spending account, which increases the temptation to use it for non-essential purchases. Another mistake is not defining a clear target amount, which prevents the fund from reaching a meaningful level of protection. Some individuals delay starting because they believe they must accumulate the full amount immediately. In reality, emergency funds are usually built gradually through consistent saving. Another common mistake is chasing higher investment returns with money that should remain safe and accessible. Emergency funds serve a protective function, and safety should always take priority over returns. If you are starting from zero, building an emergency fund may initially feel overwhelming. But the process can be approached gradually. Start by calculating your essential monthly expenses. From there, set an initial goal of saving 1 or 2 months of expenses. Over time, gradually build the fund toward 3 to 6 months of coverage. Automating small monthly transfers into a separate account can make the process easier and more consistent. Even modest contributions, when continued over time, can build meaningful financial protection. Windfalls such as bonuses, tax refunds, or unexpected income can also accelerate progress if a portion is directed toward the emergency fund. Emergency funds rarely feel exciting compared to investments or wealth-building strategies. They don't promise high returns or rapid growth. But their value becomes clear during difficult moments. An emergency fund protects your long-term investments from being sold prematurely. It prevents unnecessary debt during temporary crises. And it provides peace of mind by ensuring that unexpected events do not immediately become financial emergencies. In many ways, emergency fund planning is the first step toward responsible financial management, because true financial security doesn't begin with aggressive investing. It begins with resilience.